It's September 1st, 2025, and China's factories have delivered a surprise that few saw coming. After months of slowdown, uncertainty, and global concern, manufacturing in China actually grew in August, defying expectations and reversing a worrying trend. This unexpected rebound has caught the attention of economists and investors worldwide, sparking new debates about the future of the global economy. The big question now is whether this is just a temporary blip, or the start of a real, sustained recovery for the world's manufacturing powerhouse. China's manufacturing sector is the engine of its economy. When it's running, millions have jobs, global supply chains hum, and businesses around the world feel the impact. For months, forecasts predicted more weakness, with many experts bracing for further declines. But the latest data tells a different story, hinting at renewed momentum. The sudden uptick is a rare moment of optimism for the world's second-largest economy, offering hope to workers, businesses, and policymakers alike. Manufacturing is at the heart of China's economic power, making everything from smartphones and computers to cars and heavy machinery that are shipped worldwide. When factories are busy, the economy is healthy. When they're slow, the effects ripple worldwide, disrupting supply chains and impacting markets from Asia to Europe and the Americas. Any sign of growth here is significant, not just for China, but for the entire global economy that depends on its output. Despite ongoing challenges like weak demand, trade tensions, and rising costs, China's industrial base has shown resilience, at least for now. The world is watching closely to see if this momentum can last, and what it might mean for the future of global trade and economic stability. To understand this news, let's talk about the Purchasing Managers' Index, or PMI. The PMI is a crucial economic indicator that provides insights into the health of the manufacturing sector. Think of it as a monthly health check for factories. It gives a snapshot of the manufacturing sector's performance. Each month, purchasing managers answer questions about production, hiring, and new orders. These questions cover various aspects of their operations. Their answers are combined into a single number, the PMI. This number is a composite index that reflects the overall economic activity in the manufacturing sector. Above 50 means growth, below 50 means contraction. This threshold is critical for understanding the direction of economic trends. It's one of the first signals of how the economy is doing each month. Analysts and economists closely monitor this indicator. Even a small move above or below 50 can mean a lot. It can indicate subtle shifts in economic momentum. For example, 51 signals expansion, while 49 signals decline. These numbers help businesses plan their strategies. The PMI is like a thermometer for the economy, simple, fast, and powerful. It provides a quick read on economic health. Governments, investors, and business leaders all watch it closely. They rely on it to gauge economic conditions. It helps them make quick decisions about spending, hiring, and investment. The PMI's influence extends across various sectors. That's why this month's PMI matters so much. It provides a timely and accurate measure of economic activity. The August PMI shocked everyone. It wasn't just a minor surprise, it was a complete reversal of what most experts had been predicting for months. Most analysts expected another weak month, with the PMI staying stubbornly below 50, signaling continued contraction in the manufacturing sector. The consensus forecast was 49.8, another sign of contraction. For many, this number seemed almost inevitable given the recent economic headwinds. But the actual number, 50.5. That's not just a small beat, it's a clear move back into expansion territory. Not a single expert predicted it would be this strong. The result left even the most seasoned analysts scrambling to explain what they'd missed. The jump from 49.5 in July to 50.5 in August is a big deal for an index like the PMI. A full-point swing in just 1 month is rare, and signals a meaningful change. It signals a real shift on the factory floor. More new orders, higher production, and a sense of renewed optimism among manufacturers. The news made global headlines and forced everyone to rethink their outlook. Suddenly, the narrative around China's economy was changing. For China, this was a rare upside surprise. It's not often that economic data so dramatically beats expectations on the world stage. It's like expecting rain, only to wake up to sunshine. The mood shifted almost overnight, with hope replacing gloom. The result suggests conditions are improving faster than anyone thought. Analysts are now racing to update their forecasts and models. Now the world is recalibrating its expectations for China's economy, watching closely to see if this momentum can be sustained in the months ahead. This growth is good news, but it's not the whole story. China still faces big challenges, like tariffs that make exports more expensive and weak consumer confidence at home. One strong month doesn't erase these problems. If Chinese consumers aren't spending, factories will eventually slow down again. The government is trying to boost confidence, but it's a slow process. Think of it as a patient having a good day, not a full recovery. The path ahead is still uncertain and likely to be bumpy. This data point is a step forward, but many more are needed. Why does a single number like the PMI matter so much? It's an early warning signal, based on real-time decisions from factory managers. For global businesses, a rising PMI means more demand for raw materials and products. For policymakers, it guides decisions on interest rates and stimulus. A strong PMI gives hope, a weak one signals trouble. It's a snapshot from the front lines of the economy. The August bounce back reminds us that economies can surprise us. Even in tough times, resilience can appear when least expected.